participate in this important event. I'm very familiar with the long and spectacular history of the Landon Lecture Series, and I'm very pleased to be part of it this morning. The Landon Lectures were begun in 1966 by the late Governor Alf Landon and the late K-State President James McCain. The goal of the Landon Lectures is to bring the most prominent public figures to Kansas State University to discuss the pressing issues of the day. We are very pleased today to welcome Chairman Sheila Bair to the Landon podium to join 153 predecessors in bringing her thoughts and opinions on important public issues. Before introducing members of the platform party, I'd like to introduce some special guests in the audience. Our platform party today is on my left, Professor Melody LaHue, Apparel and Textiles Design and President of the Faculty Senate. Mr. Dalton Henry, Senior in Agricultural Economics and Agricultural Communications and President of the K-State Student Body. And then on my right, Dr. Charles Reagan, Deputy to the President, Chief of Staff, and Chairman of the Landon Lecture Series. Mr. Ed Seaton, Chairman of the Landon Patrons and Editor-in-Chief and Publisher of the Manhattan Mercury, was not able to be with us today and regrets that he was not able to join us for this Landon Lecture. It's certainly my honor to introduce to you this morning Sheila Bair. She is the Chairman of the United States Federal Deposit Insurance Corporation, or better known as the FDIC. She was appointed to the post for a 5-year term on June 26, 2006 by President George Bush. Ms. Bair will also serve as member of the FDIC Board of Directors through July of 2013. In 2008, Forbes magazine ranked her as the second most powerful woman in the world behind German Chancellor Angela Merkel. Forbes described her FDIC office as, quote, the last stop for capital-starved banks and their insured customers before going under, end quote. Ms. Bair is a native of Independence, Kansas. Her father was a surgeon and her mother a nurse and homemaker. She received her bachelor's degree from the University of Kansas, and in 1978 she received her Juris Doctor from the University of Kansas School of Law. Ms. Bair has served as the Dean's Professor of Financial Regulatory Policy at the Eisenberg School of Management at the University of Massachusetts at Amherst. She has been Assistant Secretary for Financial Institutions at the U.S. Department of Treasury, Senior Vice President of Government Relations at the New York Stock Exchange, a Commissioner and Acting Chair of the Commodity Futures Trading Commission, and Research Director, Deputy Counsel, and Counsel to Kansas Republican Senate Majority Leader Robert Dole. Please help me welcome the 154th Landon Lecturer, Chairwoman Sheila Bair.
Thank you, Kirk, for that very, very nice introduction, and good morning to all of you. It's a great joy to be back home in Kansas. There are few places on earth that compare with Kansas and the hardworking, stand-up people who live here. Wherever I've worked or traveled, I've never forgotten the basic American values of liberty, opportunity, and common sense that I learned while growing up in Independence. And like a lot of Kansans, I was taught to be honest and direct. Alf Landon, as we all know, never pulled a punch in politics, which he once remarked would be a sin. He was a thoughtful problem solver, always promoting the common good, not the expedient. Despite opposition from some in his party, as governor in the middle of the Great Depression of the 1930s, he embraced many parts of President Roosevelt's New Deal. And he used his common sense in getting at the heart of the problems in his own state by lowering taxes, pushing for utility regulation, passing a moratorium on mortgage foreclosures, and sponsoring laws to bolster troubled banks. We need more men and women in Washington with that kind of courage and boldness, and I hope to think that I am following in Alf's footsteps. We're tackling the aftermath of a financial and economic crisis that has done as much, if not more, damage to our country than a Kansas tornado. How will we weather this crisis? How will we protect consumers from the abusive practices of the past few years? How do we stop the excessive risk-taking? How do we keep people in their homes? How do we prevent more of those massive bailouts of giant financial institutions? As a lifelong Republican and market advocate, it's not exactly been easy for me. The government has been going into places where we don't want to be. We've been doing things we'd rather not be doing, but have had little choice. So I want to talk today about how the stability of our financial system was jeopardized to the point that the federal government was forced to intervene in ways that were unthinkable just a few years ago. I also want to talk about what we've learned from this very painful episode and what must be changed to avoid these problems from recurring in the future. It's hard to believe that just a few years ago, economists were touting the Great Moderation, a pattern of long expansions punctuated by brief and mild recessions. Interest rates and inflation were low. Easy credit in the wake of the dot-com bust and 9/11 terrorist attacks buoyed the demand for real estate. Easy lending standards led to an increase in home ownership rates, and home prices rose throughout most of the country. Few homeowners defaulted on their mortgages as home price appreciation, historically low interest rates, and relaxed underwriting standards made refinancing an easy and attractive option. Financial institutions also thrived in this low interest rate and easy credit environment. This was true of banks, as well as a growing shadow sector of non-bank credit providers. From June 2004 through February 2007, not a single bank failed. This is the longest period without a bank failure in FDIC history. The banking industry posted quarter after quarter of record profits. Non-performing assets were at historical lows, and U.S. bank capital levels were strong, both historically and by comparison to their global counterparts. Underneath this golden veneer, a huge asset bubble was building. In order to maintain earnings growth, financial institutions found ways to increase leverage using securitization and off-balance sheet financing. Existing homeowners were eager to tap their newfound home equity. Others were anxious to become homeowners, but were unable to qualify for a traditional mortgage. Financial institutions created new mortgage products, many of which could only be repaid if home prices continued to climb, and thereby made credit available to ever more risky borrowers through unsustainable mortgages. I started becoming concerned about predatory lending and subprime mortgages in 2001 when I was Assistant Secretary for Financial Institutions at the Treasury Department. Some lenders, generally not banks, were offering mortgage loans that borrowers couldn't afford. These subprime loans were financed through Wall Street securitization vehicles and were replete with exotic features and complex fees. While my concerns were justified, my warnings did not resonate at the time, in part because rising home prices enabled weak borrowers to refinance and push their problems into the future. So even where federal powers existed to regulate non-bank mortgage lending, they were not used. The wave of defaults and problem loans would not come until the housing price bubble faltered. In early 2007, as chairman of the FDIC, I began to speak loudly, clearly, and frequently about the wave of mortgage payment problems that would hit the industry. I have long advocated for proactive and sustainable loan modifications as a cost-effective way to deal with unaffordable mortgages. And as an advocate of foreclosure prevention, I hope Alf Landon would have agreed. Modifications can help lenders and families avoid the financial and personal losses associated with foreclosure. As we have now seen, the subprime mortgage problem has turned into a prime mortgage problem as the economy has declined. Far too many families are facing foreclosure because of lost income from economic distress brought about from the subprime debacle. These developments set the stage for what followed, the worst financial crisis since the Great Depression. Let me go over the dramatic events that helped shape this crisis. Inevitably, the housing bubble burst. The decline in home prices led to a large-scale downgrade in the credit ratings of a variety of complex financial instruments, CDS, CDOs, CDO squared, terms most Americans, as well as a few financial executives, had never heard before. Ultimately, the losses from the bursting bubble exposed how much risk had been created in the financial system. As the crisis unfolded, it became clear that potential losses would be large and would threaten the viability of many larger financial institutions. As we all know, any talk of the Great Moderation ended in 2007. In June 2007, Bear Stearns announced devastating losses for two of its subprime hedge funds, which had been marketed as low-risk investments. These losses prompted a cascade of rating agency downgrades of similar investments, and the financing that had been available through securitization and structured credit markets quickly dried up. Mounting credit losses shook investor confidence, and firms became unwilling to do business with each other in ways that prior to these events had been routine and perceived to be low risk. As 2008 unfolded, conditions in the mortgage and other markets continued to deteriorate. Many non-bank mortgage finance companies went out of business. In March, Bear Stearns was acquired in a Federal Reserve-assisted transaction by J.P. Morgan Chase. And in July, IndyMac Bank, a large thrift in California, failed, resulting in the most costly bank failure in FDIC history. Soon after, Fannie Mae and Freddie Mac were forced into conservatorship, and in September, Lehman Brothers filed for bankruptcy. The insurance giant AIG received $85 billion from the federal government to avoid collapse and would eventually require another $100 billion. WAMU became the largest insured depository institution to fail, though thanks to the FDIC's resolution powers, it was sold in a seamless transaction that required no support from the government and fully protected all depositors. Liquidity in the interbank market evaporated, and the United States was not alone in facing this crisis. In September 2007, Northern Rock, a large mortgage lender in the UK, experienced a liquidity crisis and a subsequent run by depositors, the first bank run in the UK in over 100 years. By the end of 2007, Northern Rock had received a huge loan of almost £27 billion from the Bank of England. By February 2008, the UK government was forced to take ownership of Northern Rock. And in the fall of 2008, subsequent banking crises swept through many Western European countries and again in the UK. In the fall of 2008, the U.S. authorities took a series of internationally coordinated actions to contain the damage from the collapsing financial system. The Congress passed the Emergency Economic Stabilization Act in October, which funded the U.S. Treasury's Temporary Asset Relief Program, known as TARP. The FDIC's deposit insurance limit was temporarily increased to $250,000, and temporary guarantees were instituted for money market mutual funds. The Federal Reserve opened new lending facilities to provide funding to a much wider range of companies than have historically been able to borrow from the Fed, targeting firms burdened by large holdings of now illiquid mortgage-related securities. The FDIC created the Temporary Liquidity Guarantee Program to guarantee bank and holding company debt in order to provide liquidity. And the Treasury invested hundreds of billions in large institutions to stabilize them and provide them with fortress balance sheets. These actions were an unprecedented broadening of the federal safety net. But given the tools available, they were mostly necessary to prevent more failures of other large, complex financial institutions that would have caused severe damage for the global financial system and the real economy. Credit markets are now slowly thawing, and liquidity has vastly improved, with short-term credit spreads returning to normal levels. Equity markets have recovered somewhat, but are still well below their pre-crisis levels. With the worst of the crisis apparently behind us, it's time to consider the fallout from this calamity. While government intervention has been successful in preventing wider failures, it has also introduced moral hazard into our financial system by providing previously unimaginable amounts of taxpayer support for open institutions. Government intervention has in too many cases protected stockholders, bondholders, and managers from the consequences of their mistakes. We must make fundamental changes to our financial regulatory system to reduce this moral hazard and to make sure a financial crisis does not happen again. Reforms are needed to create a more resilient, transparent, and better regulated financial system, one that combines stronger and more effective regulation with market discipline. This crisis gives us an opportunity to achieve significant regulatory reform, and it is imperative that we meet the challenge and not sidestep our responsibilities to ensure financial stability and to protect the taxpayer. We simply cannot afford to maintain the status quo. So what's to be done? First, we must end too big to fail. Second, we must close the destabilizing regulatory gaps that exist and have more checks and balances to make sure regulators do their jobs. And third, we must do much more to protect the American consumer when it comes to financial products. To end too big to fail, we must find ways to impose greater market discipline on systemically important institutions and ensure that no firm is too big or too interconnected to fail. After all, in a properly functioning market economy, there will be winners and losers. And when firms, through their own mismanagement and excessive risk-taking, are no longer viable, they ought to fail. One thing we learned from our handling of this crisis is that too big to fail has become explicit when it was once implicit. By contrast, small institutions and their investors know that they can and will be allowed to fail. This competitive disparity makes it more expensive for small banks to raise capital and secure funding. The FDIC has resolved well more than 100 institutions this year alone. Everyone knows that small institutions are not too big to fail. Firms that the market believes are too big or too interconnected to fail distort our system. These too big to fail firms can raise large amounts of debt and equity at favorable terms that do not reflect their true risk profile. When investors and creditors believe a firm is too big to fail, they grow more complacent. Indeed, they are even more likely to encourage these firms to take on greater risk, additional leverage, and become even larger. Investors and creditors believe, and so far have been proven correct, that the government will not allow these firms to fail for fear of major repercussions for the broader market and economy. This crisis clearly revealed that today, for non-banks, we have no practical way to address this problem. We do not have an effective resolution process for handling large, complex financial firms that become troubled or are failing. The FDIC's process only extends to insured depository institutions. And without the ability to close and impose losses on systemic firms which get into trouble, we run the risk that we will have to repeat the costly and unpopular taxpayer bailouts of the past year. Foremost on the reform agenda is the need for a special legal and regulatory framework to ensure the orderly wind-down of systemically important financial firms while avoiding financial disruptions that could devastate our financial markets and economy. A resolution mechanism that makes it possible to break up and sell the failed institution offers the best option. It should be designed to protect the public interest, prevent the use of taxpayer funds, and provide continuity for the failed institution's critical financial functions. The FDIC's authority to resolve failing banks and thrifts is a good model. This is the same model that has allowed the FDIC to seamlessly resolve thousands of institutions over the years. We protect insured depositors while preserving vital banking functions. The FDIC has the authority to move key functions of the failed bank to a newly chartered bridge bank. Losses are imposed on market players who reap the profits in good times and who should bear the losses in the case of failure. Shareholders of the failed bank typically lose all of their investment. Creditors generally lose some or all of the amounts owed them. Top management is replaced, as are other employees who contributed to the institution's failure. And the assets of the failed institution are sold to a stronger, better managed buyer. If this process is applied to systemically important financial institutions, whether banks or non-banks, it would prevent instability and contagion while promoting fairness. Financial markets would continue to function smoothly while the firm's operations are transferred or unwound in an orderly fashion. The government would step in temporarily to provide working capital for an orderly wind down, including providing necessary funds to complete transactions that are in process at the time of failure. We propose that working capital for such resolutions come from a reserve which the industry would fund in advance. This would provide better protection for taxpayers. Building the fund in advance would also help prevent the need for assessments during an economic crisis and assure that the firm which failed paid something into the fund. To avoid double counting for banks which already pay deposit insurance premiums, the assessment should be based on assets held outside of insured depositories. Any costs associated with the resolution not covered by the fund would be recouped through additional industry assessments. This resolution mechanism would address systemic risk without a taxpayer bailout and without the near panic we saw a year ago. It would provide clear rules and signals to the market. Most importantly, over the long run, it would provide the market discipline that is so clearly lacking today. A reserve funded in advance through industry assessments would also provide economic disincentives to size and complexity. Another way to address the risks of systemic institutions is to make it expensive to be one. Industry assessments could be risk-based, with firms engaging in higher risk activities paying significantly more. Proprietary trading, complex structured finance, and other high-risk activities would warrant higher fees. In addition, systemic firms would be required to have in place their own liquidation plan, a living will, so to speak, which would demonstrate that they could be broken apart and sold in an orderly way. This would mean greater legal and functional separation of affiliates within these large financial holding companies, and in particular, greater autonomy and firewalls surrounding insured banks. In addition, the largest firms that impose the most potential for systemic risk should be subject to greater oversight, higher capital and liquidity requirements, and other prudential safeguards. Off-balance sheet assets and conduits, which turned out to be not so remote from their parent organizations in the recent crisis, should be counted and capitalized as on-balance sheet risks. Taken together, these measures would help ensure that our largest and most complex firms can stand on their own 2 feet without resort to an implicit or explicit government backstop. Only by instituting a credible resolution process and penalizing high-risk activity will we be able to limit systemic risk and the long-term competitive advantages and public subsidy it gives to the largest institutions under the current system. We also need better regulation of systemic risk and systemic institutions. Unfortunately, our current system has too many regulatory gaps and needs more checks and balances to make sure that regulators get the job done. In the run-up to the current crisis, our financial and regulatory systems and supervisory surveillance did not identify and address the buildup of risk within the system. In short, it failed to provide effective macroprudential oversight. We need to develop a more effective way to monitor and proactively deal with emerging risks from a system-wide perspective. We need to be able to integrate insights from a number of different regulatory perspectives, including banks, securities firms, holding companies, and others. From these differing perspectives, we must arrive at a holistic view of the developing risks to our system. What we need is a Systemic Risk Council of national regulatory agencies with the authority and responsibility to identify, monitor, and take action to prevent future systemic risks. A Systemic Risk Council would provide an appropriate system of checks and balances to ensure that decisions reflect the interests of public and private stakeholders. It should have broad authority and responsibility for identifying institutions, products, practices, services, and markets that create potential systemic risk. It should have the authority to step in and fill regulatory gaps when they are exploited in a way that threatens the safety and soundness of the financial system. And it should have authority to establish and implement minimum mandatory macroprudential standards for such things as capital, liquidity, and leverage when individual regulators fail to act. Concentration and complexity of the derivatives markets were yet further sources of risk in the current crisis. While these markets perform important risk mitigation functions, they have also proven to be a major source of contagion during the crisis. Losses on mortgages were exponentially magnified by trillions of dollars in derivatives whose values were derived from the performance of those mortgages, and concentrations of derivatives exposures among certain dealers help catalyze systemic breakdown. When the market decides a derivatives dealer is weakening, other market participants can demand more and more collateral to protect their claims. At some point, the firm cannot meet additional collateral demands, and it collapses. The resulting fire sale of collateral can depress prices, freeze market liquidity, and lead to the collapse of other firms. Derivative counterparties have every interest to demand more collateral and sell it as quickly as possible before market prices decline. The collateral calls generated by derivatives counterparty credit risk management mimic the depositor runs of the past. One way to reduce these risks while retaining market discipline is to make derivative counterparties keep some skin in the game throughout the cycle. Under this approach, the receiver for a failed institution could impose losses of up to 20% of the secured claim. This would ensure that market participants always have an interest in monitoring the financial health of their counterparties. It would also limit the sudden demand for more collateral because the protection would be capped. Standardized derivatives contracts should also be required to trade on a nationally regulated exchange or through a regulated centralized counterparty system. While we need to take these steps to strengthen the safety and soundness of the financial system, we also need to address the human side. We must make sure that consumers have access to financial products and services that are transparent, easy to understand, and competitively priced. Improved consumer protections are in everyone's best interest. It is important to understand that many of the current problems affecting the safety and soundness of the financial system were caused by a lack of strong, comprehensive rules against abusive practices in mortgage lending. Looking over the financial landscape for consumers over the past several years, I do see many positive changes in terms of technological innovations and wider availability of credit. But I also see too much emphasis on credit availability at the expense of products and services that help build wealth. I see poorly regulated and trained mortgage originators making loans to families whose biggest lifetime financial commitment will be that mortgage loan. I see complex, poorly understood mortgage contracts accompanied by indecipherable disclosures and mind-numbing legalese. I see an explosion of payday lenders and check cashers charging unbelievably high fees for the kinds of financial services you and I get for no or minimal cost at our local bank. But I also see some banks embedding complex, opaque fee structures on checking accounts and credit cards, trapping unwary or less sophisticated bank customers. Given the importance of the consumer to our overall economy, it is amazing to me that we haven't done a better job in protecting them. I think we can do better. So I support the establishment of a new agency whose sole job would be to set effective, common-sense standards and protections for consumers. And I think such an agency would help banks and the more responsible providers of consumer credit by helping to get the bad elements out of the system and creating a more even playing field for those who are trying to do the right thing. Many in the industry are working constructively in Washington for meaningful reform. Some, however, are working furiously against it. Fear is their tactic. They say reform would stifle innovation. They say reform would impede the ability of our country to grow and compete in the global economy. But these are the very same arguments used to justify deregulation in the first place. Some want us to keep the status quo, and by implication, they want to keep the taxpayer on the hook. That makes me angry. My mentor and former boss, Bob Dole, always lived his life by his father's view of the world as stewards versus doers, and he was a doer. These stewards would have us do nothing, even after millions in lost jobs and trillions in lost wealth. I'm a Republican, but I'll always be a Republican from Kansas. So I believe, as Bob Dole believes, that when it's all over, it's not who you were, it's whether you made a difference. I believe that government has a role to play in setting basic rules for protecting the common good. I believe that government is a doer and can make a difference, especially in the face of adversity and unfairness. So my hope is that Landon was right, that there are some intelligent people in Washington, even though he knew there are more of them in Kansas. My hope is that the intelligent people in Washington will be doers, willing to take on this special interest and willing to do what's right for America. Thank you very much.
Thank you. We do have time for a few questions, and we'd like to ask anybody who's asking questions to go to the microphones, please, so that everybody in the audience can hear those. So please come forward and ask away.
First, I just want to thank you for coming back to Kansas and giving this lecture. I've missed the last couple, but it's good to come back here. I'm a sophomore in economics, and my name's Thomas Summers. What I'm interested in is this importance of regulating risk-taking that you mentioned. It seems to me that these interactions the firms go through help to set prices, right? It helps to determine the value of goods. And what I'm interested in is, are you concerned that by imposing limits on this, that you will in turn constrain the value assessments that go along with the price of
Right.
these exchanges?
Well, I think that the pricing is skewed now, particularly in the capital markets with regard to debt and equity funding for larger institutions. That pricing mechanism is out of whack because of the too big to fail implicit federal guarantee. So I think if you get rid of that, I think that will hopefully help require them to pay more competitive pricing for their own funding. You can see growing disparities between the funding costs of small and large institutions because of this problem. I also think that, basic prudential standards like capital applied across the board are just common sense rules that tell all firms of a certain size, or if they're major financial intermediaries, that we do not want leverage above a certain level. And I think that helps constrain asset bubbles in good time. If you have capital, which should frankly increase in the good times, you can constrain the easy kind of credit that led to asset bubbles, and then you give them some ability to lower those capital requirements in bad times, so you increase their ability to lend. But no, setting basic rules, including basic capital standards that apply evenly, no, I don't think that impairs the pricing mechanism at all. But I think it does serve as a good check on greed and excessive leverage, which really got us into a lot of trouble here.
Thank you.
Mm-hmm. Okay, great.
First off, thanks for speaking. I'm Jonathan. I'm a freshman in economics here. The Austrian School of Economics, and more specifically Murray Rothbard, talked a lot about how the FDIC would struggle to exist as an insurance organization because really it's trying to insure, like insuring a house that's already on fire, because the fractional reserve banking system inherently, the banks owe more money at all times than they already have in their reserves at that time. So inherently they can never pay out what they owe. And so how do you justify and first I want to say, I think that fact is being shown to be true, as we've seen that the FDIC is beginning to run very low on resources and is nearing almost bankruptcy itself. So first, how would you justify the place of the FDIC as an insurance corporation in that area? And secondly, if the FDIC was to run out of its resources right now, where is it looking to get more money in the future? Would it go to the Federal Reserve? Would it increase insurance premiums or look for Congress to raise taxes?
Well, this is a debate that occurred back in 1933 when the FDIC was created. And I think the balance is that if people needed to know that it was safe to put their money in banks. And so even though there is some skewing of market incentives through deposit insurance, freely recommend that. I think the benefits of having deposit insurance for the average bank customer to know that their money is safe, and also providing stability of funding to banks as intermediaries who take those deposits and make loans, justifies the incremental moral hazard that is created. We are required to keep our own reserves that are set by statute. We can fluctuate within a range between 1.15 and 1.5. That happened in 2006. Prior to that time, there was a statutory reserve ratio of 1.25. And that was too low. Frankly, I think what we're dealing with now is too low. I came to the FDIC in 2006. Within 2 weeks, we had put out rules to raise premiums, but Congress had not given us the authority to do that until earlier in 2006. Under the old statutory regime, if a bank had a high supervisory rating, which is over 95% of all banks, you couldn't charge them any premiums so long as the reserve was above that 1.25 number. So we tried very quickly to start building up the reserves while it was still good times in 2006. So we would have some cushion, but there just wasn't enough time to build it up. So I do think going forward, one of the reforms I would like to see is to give the FDIC more flexibility to raise the premiums in good times. But I wouldn't necessarily agree that a bank, I mean, you hear a lot of Wall Street guys say, oh, banks are just inherently insolvent. Well, it's true, obviously, that if they take deposits and make loans, and they hold those loans to maturity, right? So if you had to immediately liquidate all those loans, which would not allow you to capture the intrinsic value of those loans, sure, there would be a significant shortfall. But that's not what we do. When a bank fails, we typically transfer the whole bank, the franchise with the deposits and the loans, to a healthier bank as acquirer. We provide some loss share on those loans to help us capture the intrinsic value of those loans, i.e. not their liquidation value, but what their actual value will be in terms of the return they generate versus the losses they're projected to generate. And so it actually works pretty well for us. And it's not, for instance, WAMU, when it was resolved last year, there was not a cost. Most of these institutions there is, it varies. But again, I think overall the system that we have, even though there are losses when banks fail, that is absorbed by insurance premiums that are paid by banks. And I think the counter is that it provides stability. I don't even want to think what would have happened to us last year if there hadn't been deposit insurance, because in October that was the only thing that was stable at that point. And those insured deposits stayed in those banks to provide credit. We have not, we are having stress on our industry-funded reserves. We have done a special assessment. We've raised premiums, and we're asking banks to prepay their assessments over the next 3 years before the end of the year, which will bring about $45 billion of cash. Our projections are that that should be ample to cover what our projected losses are. Again, a lot of it turns on the economy, but we're still making some pretty pessimistic assumptions about the economy, and we think this will get us through this without having to borrow from Treasury. But the average depositor should understand we are full faith and credit. We are the government. We have wide authority to borrow from Treasury up to $500 billion if we needed to immediately. So I think that with the concurrence of the Fed and the Treasury. So I think the important point is for insured depositors, they don't have anything to worry about. The government, we're full faith and credit. There's an absolute guarantee. Nobody's ever lost a penny of their insured deposits and never will. But we haven't had to borrow from taxpayers, and I hope we'll be able to avoid that.
Thank you.
Mm-hmm.
Thanks for coming to Kansas State University. I really, my name's Andrew Von-Lintel, graduated 2005, political science, geography. Basically, I completely agree with you. Without the FDIC, we would have been in a very, very bad place. And that's like the only thing that I can really support from like the 1930s, maybe Hoover Dam. Maybe, you know, there's not very many, there's about 2 things I can support, and that's one of them. But, you know, I was working as a financial advisor and talking to people, and, you know, about the only thing I could say was, you know, we have FDIC insurance. That is the difference from the 30s to today. That's the big, huge difference.
Right.
I guess I do want to thank you for being calm. There's not very many leaders in Washington that have been calm. They've caused most of the problems due to the fact that, you know, I mean, the business leadership was not leadership. They're asking for bailouts. And then the political, you know, elites, you know, they all, you know, caved to that pressure, and it's really frustrating. There's not too many people, you know, Larry Kudlow, that haven't, you know, came out and just, you know, said, oh my gosh, you know, the whole thing's going to fall apart. Now, when you say near panic of last year, I kind of laugh at that. It was a panic by any definition of the word. The FDIC is our safety net, but that's all we need. Mm-hmm. Honestly, I don't know that we need anything else. Mm-hmm. The FDIC, if you want to have a safe place to put your money, it's the FDIC. Mm-hmm. Leave everything else. Mm-hmm. Let people take risk. Let them get burned by risk. Mm-hmm. That's capitalism. That's why we're America. That's why we're better than the other countries. We don't want to be more like China. We don't want to be more like Europe. We don't want to do those things. We need to just do what we do, what we've done for 200 years, which is let people take risk. And if it works, then they get rewarded for it. If it doesn't work, then you don't bail them out.
That's right.
I don't know what to say. But
no, okay, well, I agree with you. So I think that's right. And I think, again, we want a resolution mechanism that actually works so that we can impose, if one of these institutions gets into trouble, They are put into receivership, and their shareholders and creditors take the losses, not the government. We absolutely think that's important for the proper functioning of the markets. Go back over here now. Sure.
Again, thank you for coming. I have a very short question. You proposed a new consumer protection agency.
Right.
Do you feel that this agency should eliminate cash checking and payday lending or subprime mortgages?
No, I don't think it should eliminate them. But I think there needs to be better regulation, better understanding of the prices and the APRs that are being paid on those types of financial services, and better ability to compare, frankly, across financial service providers. We have a very elaborate framework for regulated and insured depository institutions, but outside of that, at least on consumer credit, the non-bank providers, there's just really not much oversight at all. So I think it would help level the regulatory playing field for there to be more symmetrical, even regulation, and also disclosures that reflect. So if you want to, what's the difference between getting a payday loan or drawing your cross line in a credit card, that we could have this, a regulator that's looking at across sectors and providing more meaningful disclosures for consumers so they can be able to make more intelligent choices. No, I'm not saying put them out of business, no, not at all, but I do think there can be better regulation, better oversight to make sure that the disclosures that are required are being made and that they are meaningful to consumers so they can make intelligent decisions.
Thank you.
Hi. I have a question of terminology. When an asset is no longer liquid, what is it? It doesn't seem like it's solid.
Right.
So something evanescent and fleeting, as elusive as thin air, perhaps it's gaseous?
Right.
I've always wondered. Thank you.
Well, that's a good question. If it's a loan, that's why there are different rules for bank loans that are held to maturity. You don't have to mark them to market because the bank has no intention of selling that loan. They're going to keep it on their books, and they're going to service it, and they're going to collect the income that comes from it, and they'll deal with the workout if there's a loss. So liquidation value really is irrelevant if the loan is going to be held to maturity. So you don't have to get into this type of valuation issues. Now FASB is now talking about requiring everything to be marked to market, even loans that banks hold in portfolio, and that troubles me greatly. I think these loans are idiosyncratic in terms of their credit quality. There is no liquid market for a whole loan the way there is, for instance, for a commodity or a security. And so I'm afraid if we started trying to force banks to mark those when some theoretical liquidation value, when the market sees up and there is no market, you're going to have very, very low valuations. And then when it's happy times, the way it was in 2004, 5, 3, you're going to have highly inflated values. So for bank loans, this is, your question kind of leads to why we let banks hold these loans, keep them booked with reserves projected for projected loan losses deducted against them, but we don't require that they be marked.
Thank you.
Okay, great.
Folks, let's thank our speaker one last time.